Okay, let's get started here. So it looks like we have about half the audience already logged in. There's a couple things that I want to do to just kind of get things kicked off. There's not a great way for us to go back and forth as far as communication, as this is just more of a one-sided thing. So if you're on your couch in your PJs, you're safe. I can't see you, but I am texting with my father, who also happens to be on, who's going to send me the thumbs up that we can that everybody can see me and hear me. So I got the thumbs up, so we're good to go. Well, welcome. For those of you that don't know me, my name is Taylor Leary. I'm a certified financial planner and wealth advisor with Presidential Wealth Management. And over the last 6 weeks or so, we have been hit with something that is unprecedented. And the numbers about this coronavirus are kind of astronomical. And today is not about spreading fear. It's actually about getting clarity. It's about understanding the direction that we're going to be going and how I can be the guide, or at least give you some guidance on how to make this a better situation. At the end of the day, emotions are running high, and it's an extremely challenging market out there, just with the volatility, and again, with the economic uncertainty. It seems like every single day we're hearing about news that various industries are failing, or at least saying they might fail. And so right now it's just in a massively challenging time. So that's kind of the basis of where we're at. In addition to that, I've just had a lot of conversations with clients, with non-clients, and I just find that there's just a lot of fear out there, anxiety, and I've had a lot of similar conversations. So I hope today's platform will be a good way to send my message. And my message is about positivity and just kind of spreading my light to the world, and hopefully we can follow suit. So with that, I do want to cover a couple of housekeeping items. Right now, we are on a live chat or a live webinar. And what I've done is I've activated the chat button, or the chat feature. And so with the chat feature, it is actually a private message to me. What I want to use this as is a way to contact me. Nobody else is going to see the chat or the message that you're sending me. And so use this as as a question and answer type of scenario. So my hope is that this will be about 45 minutes or so. Might go more, it might go less. And then spending the remainder time to have a Q&A, to answer any questions that are kind of burning on your heart, kind of things that you want to figure out as far as it relates to kind of the macro picture. If it's very specific to your circumstance and your situation, obviously we can take that offline. The other side of that is that I have a poll. I've got three questions here, and I just want to hear from you. What is going on in your world? What do you see out there? What are you feeling with what's going on in the market? And then finally, there is going to be a way to connect with me at the end. So I will have the option, or you will have the option, to sign up for a one-to-one meeting by way of either a phone call or a video conference. So with that, let's just dive right into it. I have created a little bit of a slide deck here for us to walk through, and this is really for us to have a very succinct conversation, as there's just so much information and things are coming at us so quickly that I could be here for days talking about the newest advancements and things. So I want to start today by talking about the market, and then we'll talk about your portfolio, and then we'll kind of talk about what's next and kind of things that you can do to make yourself a better investor. And at the end of the day, managing your investments and frankly your emotions better during this market turbulence. As we know, our emotions and our money are very closely tied together. And we've seen that over the last 6 weeks with the stock market. And you might be feeling like this. One of my favorite characters is Mugatu from Zoolander. And this happens to be one of my favorite scenes. And so you might be feeling like you're taking crazy pills. And that's not unusual. And that's totally normal. I mean, we're having home quarantines. We're seeing, people going to, running things out of the shelves, toilet paper, Kleenex. I mean, you just go to the supermarkets and it's kind of crazy. So if you feel this way, you are one, you're not alone, and number two, it's okay. All right, so what's happened this year? You know, we came off such an amazing year in 2019. Market S&P up about 30%. Things were looking good. We're going into an election year. Those tend to be pretty strong as far as market returns, things like that. And now all of a sudden things have hit the skids. We are looking completely different. And so what I've shown here is just a little chart that I put together over the last few days of looking at where the 2020 peak was, and then where we've seen the trough. And then we'll talk about some of the things that have happened just in the last 3 days. So I'm going to focus a lot of my efforts on the S&P 500, the Dow Jones, the Dow 30, and then the NASDAQ as well. But I also want to give its due where it's, give bonds their due. As such a big part of our economy, I want to highlight those and then obviously talk about crude oil as well. So the last 6 or 8 weeks, we've been hit with a number of things. First, it was this coronavirus. So that started to kind of come to life around January 1st. You know, we started hearing about this out of China, that there was this mysterious flu-like thing that was actually killing people. And then all of a sudden, people didn't take it that seriously through January. And then all of a sudden we started to see things hit in the United States. And then, through February, things got a little bit more advanced. And now we are where we are. And so that's created this massive amount of uncertainty. Well, that's hit every industry across the board. And so that's, again, created a little bit of anxiety with what's going on in the stock market. You couple that with what has happened in the oil markets, this geopolitical battle between Russia and Saudi Arabia and OPEC and all of these things. That's all coupled together, and we've just seen some massive turmoil. So let's just focus on these top three for now, the top three indexes. So we saw a peak on the S&P about February 19th, and then we saw the trough on about March 23rd. That's about 5 weeks, and in that time frame, we dropped 33%, almost 34%. That is some unbelievable numbers. With the Dow, kind of a similar time frame, 37%. NASDAQ, not quite as bad, but still losing about 30% of its value over just a 5-week period. And the reason that I want to jump over to the bond world is because it is such a big deal. We think of bonds as being really safe investments. And what we found is that nothing was immune to the volatility. Now, I'm going to use the aggregate bond index, AGG, which is just an ETF. And the reason that I'm using that is that it's a very easily accessible number, and it's really easily digestible by most investors. So I'm using it for illustrative purposes only in this case, not as a recommendation to go buy. And the same thing with the investment grade bond index. I'm using the ETF LQD in this case, just as a proxy to understand kind of the volatility that we're seeing. Because honestly, these are indexes that a lot of investors own. With the aggregate bond index, that's taking in the entire world of bonds. And it was down almost 10% from its peak on just March 6th. And then we saw a low point on March 18th, down almost 10%. That is unheard of. So if you're a bond investor and that's kind of where you're at, you probably felt some of those pains. And those are, that's the bond index as a big whole. Now let's look at investment grade bonds. Now these are those, the high level, the blue chip bond indexes. That was down 21%. LQD was down 21%. And that just doesn't make sense. This massive dislocation between what actually happens and kind of this emotional cloud that we carry with investments is very, very easily illustrated in these particular numbers. So I want to just kind of bring that up because nothing was immune. And then we look at crude oil. Crude oil has absolutely gotten hammered over the last 3 months, this first quarter, where we saw a peak in 2020 right around the 6th of January at about $63 a barrel. As of March 18th, we saw a low point of $20 a barrel. That's 66% down. So again, oil producers in the United States have gotten hit really badly. This has been a big economic challenge to the overall investment horizon. So certainly some things that that are very worrisome, and some challenges across the board. What we can learn from this is that, again, nothing was immune to the volatility, and there really was no safe haven. I looked at some numbers from gold. Gold was all over. That's oftentimes people look to as a safe haven, and gold was all over the place. Although they have had a positive return this year, it has had some challenges. It's been some big swings up and some big swings down. So that certainly hasn't been, excuse me, immune to that as well. Now, through the last 5 weeks, we've seen the market have a few different things happen, some record-breaking instances. We saw the fastest move to a correction that we've ever seen. It was 6 days. Usually, we count these things in months or weeks. We're talking about days. The Dow and the S&P dropped to a correction level in 6 days, which is unprecedented and frankly unheard of. On the 24th of March, we saw the biggest move to the upside on the indexes in 87 years. So again, talking about where we'll get to some of these numbers here in a little bit and what they really mean and how that kind of impacts your portfolio. But the point I'm making is that in those times of volatility, you have really big up days, but it's usually followed by really big down days as well. So you see all of these things kind of coupled together. And this is, again, why we need to kind of think about the investment strategy. And I've got a visual here for you in a moment. Ben Bernanke came out here recently and talked about, this was just yesterday, and talked about the market as a whole from his perspective. And his belief is that this whole coronavirus, this big shock to the system, is actually more like a natural disaster. So think about the tsunami in Japan a few years ago, some of those sorts of economic shocks. But this is more worldwide. That this is more like a natural disaster than like a Great Depression. People are talking about this, especially with the job numbers that have come out. We have over 3 million jobless claims this week. That is unbelievable and unheard of. But the idea is that this is probably going to be a short shock. Now, I don't have my crystal ball, and I don't know exactly what's going to happen, but it's certainly interesting to hear some of those very intelligent investors talk about the market in that way. But what's interesting also, and this is something that should give us a little bit of relief here and a little bit of calm, is that some of the things that have happened in 2009 that really wrecked the system. So the financial markets just absolutely going into turmoil. We've made some really big progress with regard to legislation and regulation that have actually shown their true colors in this instance, meaning we've been able to flood the market. The Fed has been able to respond really quickly. And then on top of that, with the stimulus bill that's right now on the House floor, we're seeing that there's more broad-based appeal to get sort of a quote-unquote bailout. And so why I say that is that there's not one bad actor. It's not like the airline industry was being way risky and sending the virus around the world. There wasn't one bad actor. And so I think our response to this from an economic standpoint is going to be very swift and likely going to be very effective. Now, long-term effects of this, they're probably still hard to say what's going to happen. But right now, it's going to be kind of an up and down type of scenario. And I would expect that some of the volatility that we've seen over the last 5 weeks will certainly continue going forward. It's hard to say exactly what that looks like. But with these numbers here, I was just looking at some returns. The last 3 days, S&P's up about 16, 17% almost. Dow 18% up. NASDAQ 11. Aggregate bond index about 7. LQD up about 16%. So this is just in the last 3 days that we've seen these changes. So I'm showing here the percentage change to the downside, and those are earlier this week or late last week. Just this week, we've seen this massive recovery. So I'll talk about that, how that might affect your portfolio, and some things that you might want to think about as it relates to that. So your portfolio, I'm going to cover 3 core areas as it relates to your portfolio. First off, your emotions and behaviors, and then some items to consider and then obviously some things to avoid. You might notice on the screen here that I have a raft going down a rapid, and it looks like this raft is just about to flip over. Now, I do know that my father is on this call, so this might warm his heart, and I might have been listening when I was 10 years old. We grew up as a rafting family. We would go every single summer, and we used to take all of our friends and family and a lot of newbies on the river. And this type of rapid wasn't unusual for us to encounter on the Yampa or the Colorado or the Arkansas or some of the other rivers that are here in Colorado. And we would always do a safety briefing. And this safety briefing happened before the boats went in the water or before somebody actually went on one of the boats. And you might be wondering, Taylor, what in the heck are you talking about? How does this relate at all to my portfolio? I'm going to weave this analogy in through as we kind of talk about your portfolio. But why I say that is when we do the safety briefing, we talk about the life jacket and why it's so important. If the boat flips, what happens? You got to put your feet downstream. You've got to keep your head up. You don't try to fight the river. You've got to use the back row. There's a number of things that we would talk to our friends, families, and kind of those newbies to the river about what happens if the boat wraps around a rock. Because having it in a very calm environment, having that conversation is much better than trying to teach people how to save their own lives when the boat is flipping over. And so this is something that I want to bring up right now, because right now we're in a chaotic time. We're in the middle of a massive rapid, and we need to do everything that we possibly can to make sure that we don't screw it up, and also that we end up being really safe in the end, and that we end up coming out the other side, number one, better investors, and number two, unwounded by what's been happening over the last few weeks. Let's just jump into it. Behaviors and emotions. So with our behaviors and emotions, we're driven by this thing up here. I'm a golfer, and I always think that I'm a decent athlete, but I'm not that good of a golfer. And my father always says it's usually and likely because of the space between my ears, that 6 inches between my ears. It's not how good my swing is. It's not how I strike the ball. It's because I get in my own head. Now, with investing, this is actually so true because we are driven by emotion, and money is emotional. So I want to talk about two core areas of our brain. The first area is going to be the cerebellum and the amygdala. So this is going to be located, right in there, like right behind the brainstem. I've kind of highlighted it in this slide right here. And what that is that's our old brain. This is going to be the very basic part of our brain. What does that do? It basically helps us to identify a threat and then react right away. So Daniel Kahneman, one of my kind of the people that I follow, wrote a book called Thinking Fast and Slow. And he would consider this to be the fast brain. This is the brain that, is that a bear? And we need to react right away. Now, we know that we are not faced with bears on a daily basis. We don't have threats that are, necessarily right in front of us all the time. And so our amygdala and cerebellum are still activated. And they're activated by fear and anxiety and uncertainty. And so this is the area that we make those quick decisions, and oftentimes irrational decisions. What's interesting about this part of the brain, it is not it's not available for language and or reason or problem solving. So this is, again, it sees something, it makes a decision, and we have very little control over that. Now, I want to highlight this because this makes us humans. This area of the brain called the neocortex is going to be very different than any other human or any other primate or any other mammal in the world. And this is what makes us be able to build a supercomputer, to be able to build a jet engine. And this neocortex, as the name suggests, neo being new, this is the new part of the brain. This is what has developed over the last number of years, I guess, maybe 500,000 years, I don't know. But the idea of the neocortex is that the neocortex brain, if you look at a primate, let's just say a forehead that kind of fades back. It doesn't have that nice that we have. And the reason for that is that they don't have the neocortex or the developed neocortex that we have. What's amazing about the neocortex is that it is capable of language, reasoning, cognitive behaviors, as well as all of the problem solving and analysis. So this is the brain that is slow. So in Daniel Kahneman's world, this would be the slow part of the brain that kind of takes the wheels turn a little bit slower, but they're extremely efficient and extremely valuable. But the challenge is these two things, the neocortex and the cerebellum, are massively at odds with each other, and they're trying to continually override the system. And so it's our job as investors, and it's my job as an advisor, to help my clients not let that cerebellum take control and make those irrational moves, or at least those quick, impatient decisions that say sell, 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 buy, 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 because the cerebellum is that greed and fear part that really tries to take a hold. So one of the things that I've seen over the last 4 or 5 weeks, really having long conversations with clients, is that we have biases, and we are all ridden with biases. There's emotional biases, and then there's cognitive biases. And these biases really have an impact on the decisions that you make. So I want to kind of bring up about 4 different biases that I see on a regular basis during the last 4 or 5 weeks, and things that you might notice in yourself. And if you notice this in yourself, don't be ashamed. Don't feel guilty about it. We all do it. In fact, it doesn't matter how smart you are or the highest level of education. We are all susceptible to these biases, and it's okay. I get it. But it's also really imperative and really important to have open dialogue, thoughtful discussions about the decisions that you're making. So the first one is headline risk. This is also considered, recency bias. So headline risk, we are in a information age. We've got, our smartphones. I've got my phone right here, and I have had, hundreds of messages. A new bull market has begun. That was the note. This is a notice from 20 minutes ago from the Wall Street Journal. I mean, that's the kind of thing. This is going to be driving. Now, all of a sudden, all that fear and panic that was last week, well, now we've got excitement and greed. And now people want to get back on the bandwagon. And the challenge is that we have to slow down. We can't get overly consumed. The other side of this is that you also, with headline risk, have to be aware of kind of what you're consuming. Because with our 24-hour media cycle, how do they get paid? They get eyeballs. They get eyeballs. What drives eyeballs to their pages? Well, those are going to be those scenarios where they're driving fear, uncertainty, greed, what have you. So we have to be aware of that headline risk. The second area is action bias. I'll get a call from a client, and they'll say, "What are we gonna do? What do we do right now?" And the answer is probably very little. Now, it's not to say that you don't do nothing. Sometimes there is a case to be made where you make small shifts. You might do a little bit of a move to cash, or you do all this. And to tie this back into the boating, the rafting analogy, is you try to make these decisions in calm environments. So when you have a hectic environment or a chaotic situation occur, you're not making these decisions and barking out orders and going this and going that way and fighting against the stream, because we know that action bias can actually really harm your portfolio. And basically, action bias is just doing something for the sake of doing something, because oftentimes it just feels better. We can have our moment where we're selling just because it feels good, and that has short-term impacts, but has really negative long-term effects. And that is what we have to be aware of, is that we're taking action. Make sure that you're taking action with intention and with deliberation. And it's not just an emotional deal, because I've had a lot of people that, they make sense. They think that they're making rational arguments about selling their entire portfolio and going to cash. But when we made the plan, or when we built out the strategy, or when they talked about, buying XYZ company, it was because it was a strong company. They had good cash flow. They had all these things that made it a good quality company. And that now that they're going to sell, they're going to panic sell, and then feed into this precipitous drop in the market that we've seen over the last 5 weeks. So that's it. So we just have to be aware of our action bias and that maybe inaction is the best action to take. Herd mentality. This is something that we see all the time. This is through social proof. Well, my buddy did X, or I'm doing this because I'm seeing other people. And honestly, this is probably a large reason why we're seeing the shelves at Costco, at Whole Foods, just all of their toilet paper is out. And that is partially because we have this herd mentality. Somebody heard on the news that it was smart to go stock up on toilet paper. And so everybody at the same time rushed to Costco, and they sat in line for 45 minutes to get a case of toilet paper. And what I found was interesting, as a side note, is with all of these cleaning products and all these things that are happening, I think Costco came out and said the other day, they're not going to accept anybody's returns of toilet paper or cleaning products once this thing all sorts itself out. So the idea of herd mentality here is that just because your neighbor is doing it, just because your colleague at the office is doing it, doesn't mean that that's the best fit for you. A race to the exit sometimes doesn't mean that there's actual fire. It's just creating panic, and it's an unnecessary part and unnecessary energy that we're spending on our investment strategies. And frankly, we have a lot more things to care about than what's going on across the street. It's what matters in your world and what's going to affect you. So don't follow the herd or be the first one out the door kind of thing. Availability bias. This is kind of like hindsight, or headline risk, as well as recency bias. But availability bias is more driven by emotion. So I'm going to talk about a rafting story that is something that I can recite as if it happened yesterday. It was when I was 13 years old. We were rafting down this stretch of the Colorado called Westwater. And my dad was at the oars, and my mom and sister were in the front of the boat, and I was in the back, and it's June, it was high water, and it was some gnarly river. And we were going through the rapids, and then all of a sudden, I feel the side of the tube hit me in the head, and then I'm in the water. And I'm swimming, I'm trying to figure out what's going on. I look over, there's my mom in the water, there's my sister in the water. My dad's got a gash across his head because the boat hit him, and we're all in the water, and we're just cruising. There was a lot of emotion. I went back to kind of my basics. I got my feet downstream, I got my bearings about what was going on, and I calmed down. And so I kept that kind of calm. I got saved by another boat. They pulled me out of the water, and everything was good. Why I bring that up is that availability bias, that's something that I can relive every single day because the emotion to me is so strong. I thought that that was the last day that I was going to see my family alive. And so with that, availability bias is where we grab onto past experiences because of their emotional tugs that have had. So when the last 5 weeks have occurred, where we saw things go into correction, and then we went into a bear market, and now we're in a bull market, and things are all over the place. People are remembering what happened in 2009 and 2008 and 2009, what happened in 2000, 2001, what happened in 1987. Gosh, we go back to all of the corrections, all of the bear markets that we've seen over the last 30, 40, 50 years of investing. And we think that this is going to be similar, that this is going to be the Great Depression 2.0. And the reality is every situation is going to be dramatically different. And the reason that I bring up Ben Bernanke's comments that he made yesterday is because we have to put it in perspective. We can't get caught up into all of the hype and all of the stuff that's going on, because at the end of the day, if we make decisions inside of a silo, it likely is going to be the wrong decision. So we have to remember that the past experiences, yes, we can learn from them, but as we know, history doesn't repeat itself, but it rhymes. And so what we can learn is from past experiences, how things might play out in the future. And so just because something bad happened to you, maybe in 2008, 2009, you lost a home or you lost a job and you saw your market, the market drop, doesn't necessarily mean that that's going to be the case here. And maybe the last time you said, I sold at X point, it was down 15% I sold, or, maybe you sold it 30% down or 50% down, but you never got back in, and you don't want to have that same experience again. Well, the reality is that you need to have a trusted advisor on your team. And I want you to know that I'm here for you and I'm your guide through this whole thing that we're seeing right now, both the ups and the downs. And I don't think that we're out of the weeds yet, but make sure that the availability bias doesn't cripple you in your decision making. So what can we learn from this gentleman? Looks like a firefighter, maybe a newbie going after a fire hose that's full on. It looks like he's kind of all over the map. And if you think about this and what we can learn from this experience as it relates to the stock market, think about the day-to-day activity in the stock market as the end of the hose here. It's going all over. It's getting whipsawed. And so the second that this gentleman tries to dive onto where it was, it's now over here 10 feet. And then he runs over there. And what he would be doing is staying in one place and letting the hose come to him. You will notice as that hose gets closer to the screen, or as it gets closer to us, the movements are a lot less. And so we have to think about this as it relates to your investment portfolio. Yes, you're going to have day-to-day swings, and yes, we're going to have volatility. But if you keep that long-term time horizon, if you keep that focus on the ultimate goal, then those short-term swings won't have as much impact on your overall long-term strategy. But the reality is if you make big decisions that are maybe in the wrong, kind of wrong for you right now, then it's likely that you're going to throw off your long-term goals, and it's going to be really challenging to recover. So we can learn a lot from this gentleman trying to chase this. So the idea is stay put sometimes makes more sense than trying to chase it around. So items to consider. Well, I'm just going to kind of walk through each of these items and kind of talk about how they might affect you and things that you might be able to do and things to consider with regard to your portfolio. This might be a great time to look at some tax loss harvesting. Yes, we've had some amazing years. Maybe last year you took some gains and such a big market up year. But this year we might see some heavy losses. I mean, a lot of stocks are down pretty big. I mean, if you owned even bonds, those might be down. So it might be an opportunity to review your portfolio and say, you know what, this might be a good year to offload some of the stocks. Maybe you didn't love a company and you're just kind of waiting for an opportunity. This might be a good time to look at some of those losses and maybe redeploy that capital in a more efficient manner. And there's a couple of strategies that I can walk you through as it relates to redeploying cash and redeploying some money to new opportunities. Rebalancing. This is going to be a big one. So over the last 3 or 4 weeks, we've seen markets just get absolutely hammered and things have gotten maybe kind of out of whack. So your exposure to stocks may have gone down when you want to have it more. So it might be a good time to actually rebalance. And so the idea of rebalancing is that you would sell something that's up, that's more weighted than what your kind of target is, and then you'd be buying something that's a little bit further down. And so this kind of strategy right now could very well suit you to rebound and catapult you out of what we've seen from a volatility perspective. Something that was brought to my attention here over the last week is kind of what's going to happen likely over the next 3 to 4 weeks, probably 2 to 3 weeks rather, is that a lot of the portfolio managers out there, those institutional portfolio managers, they have a mandate in their investment policy statement. So this is index funds, this is mutual funds, this is pension funds. There's a whole host of money managers out there that have to abide by their investment policy statement. And so likely if they're big owners of stocks, let's say, and they have some bonds, let's say it's a 60-40 portfolio, well, their stocks have gone down significantly more than their bonds have. And so that balance, that 60-40 balance is really out of whack. So what will likely happen over the next 2 to 3 weeks is my guess is that we actually might see some institutional buying kind of because they're forced to. And it's also at the end of a quarter. So we could likely see this scenario happen, which could buoy the stock market. That might be something to the effect of what's happened over the last 3 days, but it's certainly something to evaluate. And for your own individual portfolio, certainly something to look at as far as the rebalancing effort. This also could be a tremendous opportunity to do some Roth conversions. a lot of clients talk to me about looking at opportunities as it relates to Roth conversions. And this might be one of those opportunities because we're seeing some significant down markets, right? Where things are down, even they're down from their highs, even though we've had a good recovery over the last 3 days. Moving some money into the Roths at this point could be a great way to actually bolster that Roth portfolio and catapult or jettison that growth on the back end. If we believe Ben Bernanke is telling the truth or kind of looking into the silver ball here, or the crystal ball, excuse me, that in this case, we might have some real opportunity to get some good growth out of that Roth. And as a reminder, once you convert that money to a Roth, that it's not taxable in the future, and it's not exposed to required minimum distributions, but you do have to pay tax on that distribution. So it could be this concept of paying tax on the seed rather than the crop. So look at Roth conversions as a potential opportunity as it relates to your portfolio strategy going forward, especially over the next 4 to 6 weeks. And then review your plan. This is a great time to evaluate where you are. I have had some conversations with individuals that were okay with a lot of risk, but when rubber really hit the road, they were not okay with the overall risk of the market. They're down 30%, they're down 25%, and that's just not enough, because what it is, it's actually the real dollar that they're down. Let's just say you had a $100,000 portfolio and you're down 25%. Well, that's $25,000. Again, it's a paper loss. It's not a real loss until you sell, but sometimes people just can't stomach that. So review your plan, see what your risk tolerance really is. We have some amazing tools within our network that allow us to analyze risk in a very different way. And this is something that's very proprietary to the things that we have in the tools that we have within our network and our sphere of influence. So if that's something that you're looking at, let's have a chat. Let's talk about your risk tolerance, because there might be a better way to go about doing things. I always like this because Warren Buffett is a very intelligent individual. And this is one of my favorite quotes from him. The stock market is a device for transferring money from the impatient to the patient. And the reason that I bring this up is that a lot of the times, and this will kind of play into the next slide, is that right now we're seeing a lot of impatience. Investors just are looking at the short-term performance and they're getting freaked out. And they want to get supercharged returns. They want to do all these things, but they just aren't patient enough. And the reality is that the market will just transfer that impatience to the more patient investor, and those more patient investors will take advantage of the downs in the market, and they won't sell. All right, because over time we know that the market tends to do this. All right, with periods of extreme volatility, especially highlighted over the last 6 weeks. So think about Warren Buffett when it comes to your investment strategy, and consider being patient over impatience. All right, things to avoid. This is going to be a big one here. I'm going to kind of hammer this out. And panic selling. I mean, I know for a lot of folks, it feels good to just do a short-term sell. It just feels good to, have that warm, cozy blanket to say, you know what, I'm out of the market. But as I said earlier and alluded to earlier, when there's a lot of heavy down days, there are also big up days. And if you choose to sell your portfolio on a big down day, the next day very well could be a good up day. If you sold your whole portfolio on Monday, I promise you, you're playing a little bit of regret right now. And so the idea here is panic selling is never the right choice. And the reason for this is that when it comes to buying and selling, I oftentimes, there is opportunities to buy and sell. There's no reason to just buy and forget or buy and hold forever. We're not the Edward Jones model. This is where we look at things from a very tactical and strategic aspect. And when you sell, let's sell with intention. Because if you panic sell, the challenge is that you have to make 2 decisions. You have to make the first decision, and that is, when do you sell? And then you have to make the second decision, and that is, when do you buy back in? And so you actually have to be right twice. And we know that that becomes really challenging when it looks at the long-term impact of the stock market and the long-term effects of the stock market. It's really challenging. The more decisions that we have to make as investors, the more likely we are going to get it wrong. Just think about your household. If you've got to think about 10 things before you walk out the door, you're probably going to forget a couple of those. Now, if you've got everything set up and you've got it all ready to go when you walk out to go to work, well, not right now that we're all working from home, but when you walk out and you've got your hands full, it's likely that you're probably going to forget something. So in the same case, if we can limit our decision making and how often we have to make these hard and kind of emotional decisions, the better off we're going to be, because it limits our opportunities to be wrong. So don't panic sell in this environment. Now, again, avoid focusing on short-term performance. Yes, the markets have been hit. And again, I bring up the idea that we were not immune. No asset class was immune to the volatility over the last 6 weeks. So recognize this. Short-term performance across the board has probably been pretty bad, unless you're in cash or a fixed indexed annuity or something that is not in the market at all. We have been hit across the board. All publicly traded arenas have pretty much been crushed. And that's save for a couple of areas that might be a bright spot. But with short-term performance, that is very short-sighted because it's just something in a very small window. So the idea here is that we just want to make sure that we broaden our view. What is the bigger picture? So there's two parts that I want to bring up here. Number one is limit the amount of times you log into your website, whether that's through me or that's through your 401k. Limit the number of times that you're logging in, because it's likely that you're going to feel more and more despair the more times you log in. So if you log in 15 times a day, it's not going to get any better. I promise you that. And so be cognizant of how often you're checking it. Make it once a week, twice a week. And when you do that, just do it with open eyes and say, you know what, this is the reality. These are the realities that I have to make. And these are the decisions, or maybe not decisions. And this is where you can lean on somebody like myself. We are also ending the quarter and ending a month here in the next few days. And so with that, we're going to see more people get their statements in the mail. And I suspect that there's going to be a lot of phone calls over the next 10 days because people are opening their statements for the first time in the quarter or first time in the month. And they're going to see their statement shock. They're going to see, oh my gosh, what has occurred? Now, my goal is that we can stay ahead of this. We can have these discussions there. We can be prepared for them. And it's not to say everybody's portfolio is down, but the reality is we just need to put it in context and not focus too much on the day-to-day or week-to-week movements, but rather what's the impact to the overall whole. Again, avoid following the herd. In this case, we just have to kind of shut down and put on the blinders a little bit and say, what is good for me? What's good for you as an investor today that relates to the long-term health of your portfolio? And so that's where working with somebody like myself is going to be really important to say, you don't need to make these decisions by yourself. And frankly, you don't need them with the neighbor's input or your boss's input. These are all decisions that need to be made specifically for your situation. So be aware of following the herd. And then the final thing to avoid is feeding the scarcity loop. The scarcity loop is something that I think is an overwhelming challenge in our society today. And I'll talk about the scarcity loop here. So the scarcity loop is basically where fear and anxiety create poor decisions or poor choices that result in negative outcomes. And then those negative outcomes then feed the fear. That fear then feeds the anxiety. That anxiety then creates poor choices and then negative outcomes. And then it kind of continues. And this loop continues over and over and over until there's pretty much nothing left. And we're kind of a shell of ourselves. And so when it comes to your investment strategy, this could not be more important right now. Stop the scarcity loop in its tracks and transition to an abundance mentality. This abundance mentality is highlighted by the fact that we can look at history and say, I have faith in the American economy that says the American economy is going to do good things in the future. And then at the end of the day, we're going to put the stops in place. We're going to put the safety net in place, and we're going to be resilient as human beings, as a society, and as a nation, and frankly, as a country and a world, that we are going to be better in the long run. And if you take that view, that abundance mentality, you're going to feel a lot of gratitude. Your heart's going to feel good. That's going to then play into your mind. Your mind is going to be fed with that good, positive attitude. You're going to make wise choices. And those wise choices are going to feed those positive outcomes. And so if we can take ourselves from this negative or scarcity loop to a more of an abundance loop, then all of a sudden we can perpetuate the positive vibes, if you will. And this is getting a little mushy, but this is kind of the stuff that I thrive on. And so this whole idea of abundance over scarcity is absolutely, this is paramount right now. The scarcity loop is exactly what we're seeing with the shelves empty of canned goods, of toilet paper, of Kleenex, of all of these paper products. It's kind of ridiculous. In fact, I just was talking to a client who helps online retailers, and he said the online retailers, by and large, are getting crushed. You're seeing the ski industry to get hammered. The one area that he said is a bright point for their business is the gun manufacturers and the gun producers are doing absolutely phenomenal right now. And that's probably feeding into that scarcity loop because people are fearful that something's going to happen. So let's transition. Let's do our best to go to this abundance loop so we can think about things in a more positive way, make better choices, and we'll see the positive outcomes as a result. So now what? As a whole society, as an individual, as a family, we need to just take a collective breath of fresh air. We need to evaluate what's going on. What has been the real effects of the last 6 weeks? Has that completely ruined your financial independence, or has that derailed your retirement plan? And the answer is probably not if you've done it right. And if you don't panic and you don't go into a mode of hiding and being fearful. So evaluate your situation, create a plan, work with me. Don't go into hiding. Let's have that communication. If we need to have a hard discussion, let's do it. I'm okay with it. I'm a big boy. We can have those discussions. If you're not hearing from your advisor, have a call with me. I'd love to chat with you. And then finally, execute. Create a plan and then follow through with it. A plan is nothing without execution. If Bill Belichick was a genius and he wrote down all of his plans on paper and then never shared them with the team, do you think they would have been as successful as they were over the last 20 years? Well, the answer is absolutely not. So it is all about execution. So take that collective sigh of breath, just chill out. With this time at home, we can feed ourselves with more positive energy. Stop watching the news as much. As a matter of fact, just this morning, I was sensing myself getting a little bit of despair. I was getting ready for this call. I was looking at the numbers, and the market's up, the market's down, where people are all over the map. You're seeing crazy stories everywhere. New coronavirus infection rates. It's just it's hitting developed countries, and I was just feeling overwhelmed. So what I did is I just walked outside, and it's amazing how quiet it was. There was no cars on the streets. You couldn't hear anybody. The furthest thing you could hear kids laughing in their backyard and birds chirping. It was a beautiful day here in Denver, Colorado. And those are the things that I'm thankful for. I have a brand new 13-day-old baby here, and those are the things that I need to surround myself by. So what is it in your world that provides you positive energy and positive focus? And look at that. What can you control in your life? Because it's the things that you can control that are going to create a better, stronger, more beautiful outlook on life. And finally, stay engaged. This is a time where a lot of folks are being quarantined. I mean, people are staying home. Colorado just got a statewide stay-at-home mandate from our governor. That's not atypical from all the other states here in the United States. Plus, you've got that happening in Canada and all around the world. So stay engaged. We have the technology in place that will benefit you and make your heart feel whole. So if you're feeling isolated, write a letter to somebody. Learn how to use Skype, learn how to use FaceTime. That's been one of the most amazing things. My wife and I have FaceTimed with my nieces and nephews. So my daughter my daughter can see her cousins, and the cousins can see their new cousin at our house. And it's just been such an uplifting experience. So have fun, laugh, do virtual happy hours with friends, open a beer, have a glass of wine, do whatever you need to do to stay engaged, but try to avoid the negative energy and the negative vibes that are out there. And so that's kind of my message today, is to just share that positive energy with you and hope that the scarcity loop stops and that we think about the world from an abundant standpoint, and that things will get better. And that just what's happened over the last 6 weeks doesn't mean that that's what's going to happen forever. So I really appreciate everybody taking the time today. We're about 50 minutes in. There are ways to connect, okay? So we can talk on the phone, we can schedule a video conference, and we can also share messages over email. Do all of these things. I'm happy to have discussions with each and every one of you. What I'm going to do is open up the poll right now. I'm just going to view the chat. If you guys want to start, I'm going to open the poll, start poll. So we've got, the poll is open now. I'm going to open up the offer too. I'm going to start the offer there. So we'll publish that, and then we'll do this, publish that. So if you guys will take a couple minutes to jump in the polls, that would be awesome. And then any feedback that you have, if you guys want to open it up for chat, certainly let me know. And if you guys want to jump off right now, this is a great time to do that. But I will stick around for probably the next 15 minutes to answer any questions that you have. So again, use the chat feature to ask any questions, and I'll be sure to answer those as they come in. So it looks like we're getting a message. I'm getting a message right now about the stimulus. So what do I think this stimulus package is going to do to the economy? This has been interesting. So this is changing in real time. I just printed this off before our meeting here. And they give a good outline as far as what happens to, what the Senate just passed. I'm not going to go through everything, but there's some really interesting highlights here. One of them is they are going to raise the limit for 401ks and loosen up rules on hardship distributions. So for those affected, they could access up to $100,000 from their retirement savings without the typical 10% penalty. So with that said, that could have some interesting impacts. My hope is that people can weather the storm, that they have that safety net, they have that emergency fund, so they can weather any kind of immediate storm that we're seeing here in the market and in the economy. We're seeing a lot of people affected by layoffs, the service industries, the airline industries. There's a lot of challenges out there right now, but I think that the stimulus bill is going to be a real net positive, because I think it's going to be a lot like the TARP money for some of these industries. In a better way, because they learned about what happened with the TARP money, that some of these banks didn't need it, and they ended up making a bunch of money off of that. So hopefully they do a little bit of different things, but this will be a good way to stem the tide, to buoy these companies in the short term. So a question about yesterday's returns, or just the last few days. Is this in absolute dollars or in a percentage of increase? Well, as it turns out, it's both. Absolute dollars is pretty easy, because we have such, the market, as of, it was about the Dow was at about 29,000 earlier this year. And so if we look at that, if we go down 1,000, well, that pretty much crushes a lot of old numbers. But it was from a percentage standpoint that we saw the biggest move ever in 87 years, purely from a percentage standpoint. on an intraday and 1 day market move. So that was absolutely interesting. I have a question from with managed allocation accounts, will managers automatically take the opportunity to rebalance? As a mandate, part of their investment strategy will be to do a rebalance. Typically, that is going to be on a quarterly basis. So that is something that we probably will be seeing over the next, like I said, 5 to 6 business days. Well, at the end of the quarter here, which that's going to be early next week. So yes, that will happen. We will see a rebalance more from an automatic perspective. But I will say this, we are not out of the woods yet. Just because the market did really, really well today and the last 3 days, doesn't necessarily mean we're out of the weeds. My expectation is that we're going to see some massive, massive numbers still to come out and really some challenges to our economy. So I don't think we're out of the weeds. I think that right now we're just seeing a little bit of a bounce, and that it was such a precipitous drop that we're seeing a little bit of a bounce back up, but it's not that meaningful necessarily, other than the fact that it's just gone down so much. This is a question about contributions till July. So yes, contributing additional funds to an IRA can give you that additional tax benefit. And with the extension that they've given to filing from April 15th to July 15th, they've actually also extended that window for 2019 contributions to IRA accounts. So if you didn't max out your IRAs in 2019, you just got a nice little windfall if you have the money to put into those accounts. Only from a timing perspective, you could take advantage of some of these lower valuations at the market price right now. Here's another one. You mentioned gold earlier. What happens? Okay, gold. Okay, I'll just kind of talk generally about gold. Gold is always an interesting one. You know, in challenging economic cycles, we see gold as something that we call like a safe haven type of investment, and certainly is. The challenge is that a gold investment is an investment in a commodity, and we know by and large commodities are very volatile. They go up and down and up and down, and I can show you the numbers. I can prove that to you from a logical argument standpoint all day long. But gold is in itself just a commodity. And we've seen some massive volatility. I'll just talk about some numbers. On 1/1 of 2020, we had about 1534 for an ounce. It went up 9% to a high of 1676 an ounce. Then it dropped 7%. Then it went up 7%. Then went down 12%. Went up 15%. And then went down 3%. These are as of yesterday's numbers. And so it was all over the place. It was volatile. It was jumping up and down. So gold is not necessarily a safe haven from just where, that warm blanket, that thing that you can go to and rely on all the time. Is it a piece of a portfolio or does it make sense? Absolutely. It can make sense for a part of a portfolio, but I'm certainly not a gold bug. And I do believe that there's a time and place for it, just as any investment there is. Looks like this is a hard question to ask or answer rather, and that is, how long will this last? It is extremely challenging to get this one. And we were just at our pediatrician, who very obviously a doctor, a very smart individual, and we were asking him the same thing, like, how long does this thing last? And his prediction was, I don't know, but there's a likelihood and kind of almost a consensus, it seems like, that as the summer kind of trudges in here, we're going to see probably a reduction in the infection rates. I think that kind of, because this is very flu-like, it follows kind of that flu sort of scenario. How long will COVID-19 last? I have no idea, but gosh, it certainly is going to have some real impacts in the market over the long haul. It's just now entering some of these more developing countries. So that should be really ugly and really frankly scary, and my heart goes out to them. But hopefully over the next 6 to 8 weeks, we should get a little bit more clarity around what's going on with that. If we use kind of what happened with the SARS epidemic, very similar type of infection or disease rather, excuse me, and that was back in 2002 and 2003, we use a time frame. It was basically November 2002 as we saw the first infection rates. And then it ended roughly in July of 2003. And during that time, we had 3 different peaks of infection rates. And what we saw is that the market kind of moved in the opposite direction of the infection rate. So you saw that first peak and you saw the market move down. It kind of subsided, you saw the market come back, but by the summer of 2003, the market had fully recovered back to its original peak, and then actually had well taken that over. So I don't know, again, history repeats itself, or rhymes, doesn't repeat, so it's hard to say. Will large corporations reduce or eliminate dividends due to this downturn? My thoughts is that, companies like ExxonMobil, this is actually kind of interesting. I'm just going to use them again, not a recommendation, but they've been down massively over the last 18 months. And their dividend yield as of earlier this week was about 7 or 8%. And that's kind of unheard of. But the reality is that it's likely they will not be able to keep that up at that level. And so I'm guessing that other corporations, because of the pinch on cash flow, that in the short term, dividends might be hit, especially if they have a big exposure to oil and gas. And so I definitely expect that we're going to see some companies cut their dividend or outright eliminate it for the short term, just so they have, they can kind of bolster their balance sheets. But we also have to remember how much cash a lot of these corporations have on hand. So that's been a conversation that we've been looking at over the last 4 or 5 years. Now, some of them have deployed this, but it also might create a buying frenzy, because some of these companies that aren't quite in the same position as far as the strength of their balance sheet could be under pressure. And some of these bigger corporations, like an Apple, I'm just thinking, could go out and this could be an opportune time for them to start buying up other companies. All right, so we're right at an hour. I really appreciate everybody's time, and I hope you got some value out of today's presentation. If you have any questions, certainly send something to me offline. I'd be happy to field anything that you have. You can see the poll over there. It looks like we're seeing some of that, and poll 81. Okay, nice. Okay, and then we've got some other stuff. So. There we go. That said, I really appreciate everybody's time today. Thank you so much. Send me a message, schedule a one-to-one meeting with me. I love to have these conversations. We can do it over a video conference where you get to see my ugly mug, or we can do it over the phone. I will also say that if you call my office, that is routed to my cell phone since I'd be working at home. So know that you can always reach me at my office line as well. So we're fully connected and fully operable and up and running, and have confidence in what we're doing. And I really appreciate all of my clients that were on today and their business. And if you have questions, send them to me. Thank you so much. Have a great day.